Okay, now let's start. First of all, I want to introduce myself. My name is Derek Chow. I have office in this building, IC374. Now, I have office hours on Wednesday and Thursday, starting next week. So this week there will be no office hour, but starting next week. You're welcome to drop by if you have any questions, but please be prepared. All right, so when you come to my office hour, and you should do your work before you come, right? And actually that's odd. One thing happened several years ago. A student came to my office hour and with a question and a piece of paper, all right? And I looked at that question and said, I did it in class. The student told me, well, I was not in your class. Actually, my friend, he was in your class, but he did not have time to come, so he asked me to come and have the solution. I said, no, ask your friend to come to me, all right? So you need to prepare before you come to my office hour. That is, you need to prepare the question, and you need to read the material, understand it, and let me know what part of the question you have trouble with, all right? The same thing for email question. I strongly encourage students to email me your question whenever you have one. All right, doesn't matter if it's 3 a.m. or any time. I stay very late, all right? And I normally go to bed about 4, okay? So I will try to reply all email in the same day. So I promise to reply in 24 hours because sometimes I may be on road, sometimes I may be in the class, all right? So I promise to reply in 24 hours. And if you do not receive my reply in 24 hours, please send it again. I will not reply to certain type of email. All right. Once is received it after the final exam, and asking me to give them a passing grade, I will not reply to those email. I'm sorry. All right. And other type of email that I would not reply this to try to make sure I would not reply is your late submission of your assignment or your email submission. All right? You send your answer to me by email saying that you have trouble or problem uploading your answers to Quaker. Now I would not reply those emails. I would not accept any email submission. I would not accept any late assignment. All right? So you have to submit or upload your files to Quackquest before the deadline. All right, absolutely no late assignment will accept. Okay, I want to make it clear to everyone. Okay, and now when you send me email for question, again, please be specific. Okay, prepare, and most of the time I will require you to show me your work. All right, maybe you have a problem with one of the end of chapter problem, so send me your work and I will comment on your work. All right, do not send me question, can you explain chapter 4 to me? Can you explain this topic to me? For those, I cannot help. All right, so please prepare before you send me the question. Sometimes when you write the question, actually help you understand the problem. Trust me. Okay? Because when you try to write the question, actually you have to think about it. So when you're doing that process, you learn maybe you solve half of the problem already. Okay? So you can send me an email anytime, any weekend, weekday. Well, if you ask certain personal or confidential information, you have to use your UFT email account. If you just ask a general question, you can use any Yahoo Mail, Gmail, Hotmail, any email account. And you don't even need to let me know your name. You can call yourself John, Mary, whatever. That's absolutely fine. Now sometimes if I find the question is interesting and other students may have similar question, I may cut and paste your question, my answer to Quaker's discussion board. All right, but don't worry, I will not include your name here. All right. My phone number, and I seldom answer any phone call, so please use email rather than calling me. So this is section 02. Now, I will take attendance starting week 3, and if you attend other section, absolutely fine. Please write your name and sign at the bottom of the attendance list, right? All right? But please try to attend this section. You'll enroll this section as much as possible. But I know sometimes you have some kind of, other matter you you need to deal with, so you may attend other sections, but that's absolutely fine. Okay? Now this is Mgfc10 is a continuation of B10. So in B10 we study one of the 3 major decisions in corporate finance. Right? In corporate finance, the first decision, so we have current asset, current liability, fixed asset, long-term asset. We have debt. Oops, sorry. And now, this is long-term asset, fixed asset. In B10, you learn capital budgeting. So capital budgeting is to calculate the NPV of a long-term asset investment, a project. So if the NPV is positive, you go ahead and invest in that project or buy that machine, right, or equipment. If the NPV is negative, you reject it, so you do not invest in that project or fixed asset. Okay, so that's the first decision, investing decision. Now the second decision in corporate finance is financing decision. Now I will use B or D to represent debt. So B stands for bond, so I will either use BS, stand for bond and stock, or I will use D and E, which is debt to equity. So these 2 are the same. All right, I will use these 2 terms interchangeably. Okay. So financing decision is the one we will look at in this course. So if you look at it here, we look at the cost of capital, capital structure, dividend policy related to the capital structure, long-term financing, equity and debt, and lease and buy decision. They are all, the first 5, they are all related to the financing decision, related to this part, the right-hand side of the balance sheet. Okay? Now the last one is derivative security. Mainly we look at option. Now I will discuss a little bit about futures and forward contract, but they will not be tested in the examination. Only option will be tested in examination. But I will introduce what a futures contract is, what a forward contract is, and also a swap contract. All right, but I spent maybe 30 minutes to just introduce the idea, but we will not go deep in those topics. But options, I will spend 2 weeks on option at least, all right? Because some of you, this is the last finance course you may take in your undergrad study, and we want to give some exposure, some option exposure to you, all right? Because option is almost everywhere, not just in financial market, but any other area. You can also apply option theory in many, many other areas. All right? So I will talk about option. Now, warrants and convertible, I may talk about it. I may choose to discuss merger and acquisition. Depends on how much time we have. Now, if we have enough time, I will cover both warrant convertible and merger and acquisition. But normally, I do not have enough time to finish all topics because I have to spend maybe half of lecture or maybe even 1 lecture on the CCA that you are supposed to learn in B10. But I don't know, many of students say, I did not learn CCA in B10, so I have to spend a lot of time to review those topics. Okay? So if I do not have enough time at the end, I may either choose to talk about warrant and convertible or merger acquisition. It depends on how much time we have. All right? Okay. So now let's come back to this. Now the third decision in corporate finance is the liquidity management. or working capital management. Some professor, they talk about it in B10. I don't know, depends on the professor. Now, why we do not officially include maybe a few lectures on working capital management? Because the methodology, the method you use in working capital management actually come from capital budgeting. Same thing. Let's say now you have a credit policy. You have a new credit policy. So should you implement this new credit policy, right? Whether you should give credit to some customer or you extend your credit term. Maybe right now your credit term is 15 days. So should you extend it to 30 days or maybe 45 days? So you calculate the NPV of this credit policy, because if you give more credit term, you may have more customers. But at the same time, you also have some more default or bad debt, right? So you estimate the future cash flow of the incremental cash flow of this new credit policy and calculate NPV. Is positive, then you should accept or implement this new credit policy. If negative, then you should stick with the current credit policy. The same thing for inventory. So how much inventory you should carry? Again, calculate NPV. So if I use this level of inventory, my NPV is this. If I use high inventory level or inventory system, my NPV is this. The same thing, decision. All right? So I'm not saying working capital management or liquidity management is not important. It is important. All right? But if you understand the concept of capital budgeting and some financing, you should be able to do the working capital management easily. All right? So that's the exercise. Sometimes we do not spend a lot of time on those. All right? Now, in this course, when we say debt plus equity, that's equal to your firm value, which is total asset. Now, this is this amount, not the total asset on this side. Because if you look at this part, now this part we call it spontaneous financing. Those spontaneous financing, you don't need to arrange. This current liability, you don't need to arrange. Now, when we have short-term debt, they are here. So this is different from accounting. In accounting, current liability include short-term debt. But in finance, when we say current liability, they are related to the operation current liability, like wages payable, account payable. Those liability from operation. You don't need to arrange financing. So that's why we call it spontaneous financing. They are automatically there. You don't need to arrange it. But short-term debt, you need to go to the bank and borrow and negotiate with the bank. So when we say debt here, include both long-term, short-term, or interest-bearing debt. Even pension should be there, because pension actually is interest-bearing. Okay, so make sure, so when we say the asset of a firm actually is this amount, excluding those spontaneous financing. Right? So you read this on this learning objective. Now B10 is a prerequisite, so you need B10. Now B10 you learn time value of money calculation, and I assume you should know all of them. But anyway, today I will spend maybe 10 or 20 minutes to review those 4 important time value of money calculation formulas. All right? So this is not an excuse. You took B10 a year ago, you forget everything. No. I assume you need to go home and review your B10 notes, because some of the time value of money calculation, we need it very often in this course. Okay? Now the textbook we are using is a 9th Canadian edition. All right? It's not the international or US edition. So if you have the 8th Canadian edition, it's fine. You can still use the 8th Canadian edition. The only difference is, let's say, the CCA rate and some of the tax rule. But anyway, the 9th Canadian edition, the tax rule are outdated anyway. but we will keep using that rate to be consistent. So I will talk about it more when we discuss the CCA calculation in chapter 18. Okay? Now, some of the questions from from 8th Canadian edition are different from the 9th Canadian edition. Their difference is only the question number. So if you look at the end of the slide, I include some end of chapter problem. Now if I give you, let's say, question 9 of chapter 13, so you should see a question 9 there. But if after the question 9, I put a little bracket and put another number there, now that number is the question number in the 8th Canadian edition. So if you have the 8th Canadian edition, look at the number in the bracket. Okay? So they are the same question, but just different question number. Most of them are the same. Only a few are different. Right? Now, the evaluation or assessment. Now, there will be about 11 or 12 online quizzes, total of 5%. This is a free gift to everyone because you have 3 days and 7 hours to finish a very short quiz. All right? So the quiz will be available on Thursday, 5 p.m. The deadline is 11:59 Sunday. So 3 days and 7 hours. So each quiz has 2 questions. So simple calculation. And you have 10 attempts. Right? And you can do it anytime, there's no time limit. Right? That means you can work on 2 hours, 3 hours, but you have to submit it before 11:59 Sunday. Right? Now I will count the one with the highest score. So that means, let's say in attempt 1, you get 1/2. In attempt 2, you get 2/2. Then your score for that quiz is 2/2. All right? So some quizzes may require a little bit longer time, maybe 20-25 minutes. Some quizzes may only require maybe 2-3 minutes. All right? So you should work on it. Students failing this course, normally they did not do the quizzes, they did not hand in the assignment, or even they handed in the assignment, but the score is something like 10/100, 20/100. So that means they did not prepare, they did not have enough time to do it. All right? And they did not write the midterm, and they just write the final. Of course, they failed the exam. Okay? So you need to do the assignment. They are very useful to prepare for the midterm, to prepare the final exam. Actually, if you look at assignment 1, question 3, and question 4, they are the exam question last term. All right? So I just give you an idea what kind of exam question you will expect to see in final exam. Okay? And before the midterm, I will also give you some practice question, review question, and I will also give you a sample midterm. All right? Because this may be your first time you take course with me, so I give you the some idea of what kind of exam you will expect to see in let's say in February, or hopefully in February, but I don't know the time. Right? The midterm is 25%. Okay? So make sure you submit your assignment before the deadline. Right? I would not accept any excuse. Right? Internet connection, whatever, I would not accept it. So if you are worried about your internet connection, please submit your assignment early. Okay? Now, I only accept handwritten assignment. So you can either use pen and paper, write your assignment, scan it, and upload it to Quarkus, or you use your tablet or iPad, write it, and save it as a PDF file, upload it to Quarkus. Now, after uploading to Quarkus, please download the file and open it. Make sure it works and the file is not corrupted. Okay? All right? And don't send your file to other students. It actually happened, I think a year or something ago. A student sent his file using iPad, sent it to another student, right? And that student was so lazy, just erased the name and wrote his name at the beginning and upload it. So it's exactly identical file. All right? So please do not do that. You end up in this office. I encourage group studying, that's fine. Helping your classmate is good for both of you. But you should, after the discussion, you should go back to your own room and work on your own assignment, please. All right? Because it will help you prepare for the final and the midterm. Now the midterm is 25%, I don't know the date yet, but there's nothing to lose to write the midterm because your midterm score is the maximum of the midterm and the final exam. So if your midterm is 20%, your final is 100, your midterm will be 100. All right? You'll always take the highest of the two as a midterm score. Now do not bring any graphing calculator to the midterm and the final exam. I will only accept scientific and or financial calculator. You can bring more than one, but it has to be financial or scientific. No graphing calculator. Now the crib sheet, again, has to be 8.5 times 11. Right? 8.5 by 11. If you do not have letter size paper, let's say you only have A4, you don't have letter size, come to my office, I can give you a few letter size paper. Okay? You can write on both sides. Handwritten. I only accept handwritten. Okay, so I don't want anything happen during the exam or midterm. So please follow the rule. Okay. Now the examination will be cumulative. That means there will be question from the first half of the course in the final exam. I guarantee there will be question from the first half. So don't think of, okay, I do not write the midterm, I just study the second half and write the exam, I get an A. No way, you have to study the whole thing. Actually, the first half are harder than the second half, right? So that's why I want to test some of the topic again and again. Make sure you understand the concept, you understand the theory, you know how to solve the problem. Okay? So read this, no late assignment, no email submission. Absolutely. So all others just same thing. Okay. So this is the topic right here, the schedule. This is the schedule we are looking at. So today we're looking at cost of capital, and the next 2 weeks we'll spend time on capital structure, chapter 16 and 17. And chapter 13 will be capital budgeting, dividend policy, everything. All right? Okay, any question about the course online? Okay. Now the next thing I will look at is to review the time value of money calculation. Now, in time value of money calculation in B10, we learned 4 formulas. Perpetuity, growing perpetuity, annuity, growing annuity. All right? Now before that, I want to make sure you have this concept in mind. It's in time value of money calculation, the most important step is to determine or define what a period is in the question or in the calculation. If you do not get it right, you screw up the whole question, trust me. All right, so the first step is always determine what a period is in this calculation. How? Look at the frequency of the payment. If the payment is monthly, then a period is a month in that calculation. If the payment is every 6 months, semi-annual payment, then one period is 6 months in that question or in that calculation. If the payment is every 5 years, then one period is 5 years in that question. All right? Always define a period first. After you define the period, then you change all variable into that period's measure. So let's say if the payment is every month, then you need the monthly interest rate in the calculation. You need how many months of payment you have. All right? So let's say if you have 2 years and you make monthly payment, then your T, the N in the calculation is 24 because you have 2 years, 24 months in there. All right? So everything is expressed in that period term. Then you will be fine. If you do not, then very likely, or I would say 100%, you get a wrong answer. Maybe very close, but not theoretically correct. Okay? Now, the first equation, actually, this is the only equation you need to know, because if you have that, you can derive the other 3 easily. So the first equation, or the only equation you need to know, is the growing perpetuity formula. So the growing perpetuity formula is just a present value of C at time 1, C times 1 plus G at time 2, C times 1 plus G to the power 2 in time 3, C times 1 plus G to the power 3 in time 4, and so on forever, right? Okay? And unless you use series, otherwise it is hard to calculate this present value because you have infinite number of terms, right? But one way we can do is if you multiply this equation by 1 plus G over 1 plus R, right? So how do you remember this? Because 1 plus G is in the numerator and 1 plus R is in the denominator. So we just multiply both of them, all right? And what you have is the second equation. So I do not change anything. They're the same, exactly left equal to right. Now, since you have 2 equations, you can subtract the second equation from the first equation. So you still do not change anything. So if you subtract this equation from the first one, so your left-hand side, you should have present value minus 1 plus G over 1 plus R times present value. So this is your left-hand side. On the right-hand side, you can see this term and this term will cancel out. And this term and this term will be cancelled out. This term and this term will be cancelled out. So you can always find one term, the corresponding term, to cancel out the terms. All right? Okay, so you may say, okay, no matter what, we still will add one extra term. But don't worry about that. That extra term will be millions years or millions period in the future. So what is the present value of let's say I'm even gonna give you $10 billion. What's the present value of $10 billion a million years later? It's 0 today. All right? Okay? So therefore, don't worry about the extra term because they will approach to 0. So if you look at it, the left-hand side, you only have C over 1 plus R left because they all cancel out. So now you have this expression. What you need is do some manipulation. Then you have the famous growing perpetuity formula. All right? So if you have $5, 5 times this factor. You have $10, 10 times this factor. All right? Okay? And one thing I want you to keep in mind, using any of these 4 formulas, the present value you get is always 1 period before the first cash flow. So this is year 1 cash flow or period 1 cash flow. Then the present value here is period 0. Always 1 period 4. All right? Okay? And now, only case this question does not work is when G is greater than or equal to R. When G equal to R, this is 0, undefined. Because you divide a 0 is undefined. When G is greater than R, this term will be negative. Doesn't make sense. Right? The present value of positive cash flow equal to a negative value. Doesn't make sense. Okay? So therefore, because the G actually, if G is greater than R, the cash flow actually grows larger than discounted. So when it grows, that means your cash flow is getting bigger and bigger. Discounting is have your cash flow getting smaller and smaller because present value. Right? So if G is greater than R, you do not have a finite number. Okay, so there's no way you can find the present value of a growing perpetuity if G is greater than or equal to R. So this formula only works if G is less than R. All right? Now, the second case is just perpetuity, just simple perpetuity. So this is a special case if G equal to 0, so you have the perpetuity equation. Now this is the most used equation in this course. In this course, very often we assume perpetual cash flow. That is, you have the same amount of cash flow per year forever. So the present value is just that cash flow divided by the discount rate. Okay? So you have to tell the difference between this. Right? So this is the present value of multiple cash flow forever. This is just the present value of $1 in one period. Okay, so the two are different. They are not the same. Okay. Now the first formula is the growing annuity formula. Now what is a growing annuity? Now growing annuity is this is time 0, this is time 1, time 2, time 3, and so on, all the way to time t, right? And then, so a growing annuity is you have a certain payment of, let's say, $1. So if you have C dollars, you just multiply by C, right? So let's say you have $1, and this one grows at the rate of G. So it's 1 times 1 plus G. This is 1 plus G to the power 2, and so on, right? Okay, let's assume $1. Now at time t, this is 1 plus G to the power t minus 1, right? Because 2 you have 1, 3 you have 2, t you have t minus 1. Okay, so this we want to find the present value of this t period growing annuity, right? It has an end. It's not forever. It has a period end, right? Now, how do we get this? So we don't have a formula, but don't forget we have a formula for growing perpetuity. So let's assume this one continues. So if this one continues, this is 1 plus G to the power t, and this is 1 plus G to the power t minus 1, and then continue, right? Okay? So now, if we assume it continues forever, we have an equation for that. So which is 1 over R minus G. So this time, the first cash flow happened at period 1. So using the equation, you get the present value 1 period. Always 1 period, not 1 year, not 1 month, 1 period, whatever the period is before. So the first cash flow at period 1. So now you get the present value at period 0. Okay? But this is not what we want. Right? We don't want the red portion of the cash flow. So what we can do is get rid of the red. Right? Subtract it, take it out. So how do we do that? If you look at the red cash flow, let's assume you're here. All right? You stand at this point. If you look at the red cash flow, it is a growing perpetuity. It lasts forever. It grows at G forever. Right? So we can use the formula. So if you do this, so you find the present value. So this is 1 plus G to the power t, which is the first cash flow, right? Right? And using the growing perpetuity formula, you get the present value 1 period before. Right? The first cash flow happened at t plus 1. So using the formula, you get the present value at t. Right? So now you want to subtract it, but we cannot because this is the value at time 0, this is the value at time t. Theoretically, in time value of money calculation, we can only add or subtract value or numbers when they are at the same point on the timeline, theoretically. All right? Okay, so therefore we need to bring it back. So we have to bring it back. So this one is to bring it back to time 0. So if you discount it for t period, now this is the value of time 0, you subtract it. So that's why we have this equation. We have this equation, or you can write it right here. Right, so this is the first term, blue one here. This is a red one. Okay? So that's the reason why I always write the equation like this. So you can remember this is forever, and this is the second part I don't want. Okay, right? So this is the equation to calculate the present value of a growing annuity. Questions? Now this formula still works even when G is greater than R, right? So when G, if you look at it, when G is greater than R, you may say, okay, this becomes negative. Don't worry, this is also negative too, right? So negative, negative become positive. And this one will be greater than 1, because when G is going to be greater than R, this is greater than 1. So you add something bigger, so this value will always be positive. Right? So even G is greater than R is still positive, because it's a limited number of terms. Right? The sum will converge to a finite number anyway. Okay? But the only problem with this equation is when G is equal to R, it's still undefined. Right? So if G equal to R, then you have an alternative formula which is relatively short. Right? Because if you look at this equation, when G equal to R, now this is the growing, this is up to period T. Right? So this is a T period growing annuity up to period T. Right? But when G equal to R, you can see this one and this one cancel. You only have 1 left. This is 1 plus G to the power 2, cancel 1 plus R to the power 2, cancel. So what you can see is you only have C over 1 plus R left. How many of them? N of them. So that's why you multiply, T of them, sorry. You don't multiply by T. Alright? So when R equal to G, you cannot use this equation, but you have an alternative equation, even simpler. Right? Just how many years you have, T divided by 1 plus R. That's the growing annuity. Okay? Now the final one is the annuity formula. So annuity formula is the equation that we always we use quite often in this course as well. All right, and the same idea for annuity. So annuity again 0, year 1, year 2, year 3. Every time you have $1 up to year T, right? And the thing is, we want to find the present value of all this, but again, we don't have a formula. So what we can do is assume it continues. So this is T plus 1, T plus 2, and so on. And now you also have $1 forever. Okay? So now if you assume it lasts forever, we have the equation. So this is 1 over R. Right? But we don't want this part. We want to take it out. So we find the present value of this part. So this time, so this one go here is 1 over R. Because now you have the same $1. And same dollars last forever. Right? And this one happened at T plus 1. So using the annuity perpetuity formula, you get the present value 1 period 4, which is at time T. Right? So before you subtract it, you have to bring it back to time 0. So that's why we have this equation. Alright? Now, in assignment, in examination, if you write the short form, PVAF, present value annuity factor, I will accept it. So you don't need to write the long equation, but it's up to you. If you want to write the equation, or you can just write PVAF to save some time, I will accept it. Alright, but anyway, you have to do the calculation. You either use a financial calculator or a scientific calculator to find the value anyway. But if you don't want to write the long equation, you can just write PVAF RT. Right? So this stands for present value annuity factor. Because this square is the factor. The square bracket is a factor. Right? $5 you multiply by 5, $10 you multiply by 10, $20 you multiply by 20. Okay? Now I will always assume the first one is the discount rate, the second one is the number of payment or number of periods. Alright? Because if you look at the equation, R comes before T. So therefore the first parameters, I will assume it is the rate. The second parameters will be the T. Alright? Now I don't know what the notation used in B10. So some students send me email asking me, because in the end of chapter problem, they use this notation, the big A. They ask me what it is. Alright, so I don't know what notation you use in B10, but this is a same. This is the notation used in textbook. This big capital letter A and RT is equivalent to present value annuity factor with the discount rate R, number of payment T. Okay? So I will use this term. So try to use this notation in exam or in assignment. The same thing for growing annuity, the growing annuity. So if you do not write this long formula, you can just write PVGAF, present value growing annuity factor. Again, the first parameter is R, the second is G, the third one is assumed to be T. Because if you look at the equation, R comes first, G comes second, and T comes last. Okay? So any question about this formula? So review your B10 notes, please. Okay, now let's come to the discussion on cost of capital. Now, in B10, when you calculate the NPV of a project, you are given the discount rate, right? We did not talk about how to get the discount rate, how to estimate the discount rate in B10. You are given the discount rate. I can tell you, the discount rate you are given in B10 capital budgeting, it is the WACC, weighted average cost of capital. All right, we did not tell you it is the weighted average cost of capital. We just said, oh, the cost of capital, all right? But it is the weighted average cost of capital, all right? Now in B10, when we calculate the stock price, we use the dividend model. We discount the dividends, and the present value is the stock price, right? Again, we did not discuss what discount rate to be used, all right? I can tell you now, the discount rate should be the cost of equity, RS, okay? Now, the third calculation in B10 is the bond valuation. You find the price of the bond. You discount all the coupon payments or interest payment and the principal or face value back to time zero. This is the price of the bond, right? You're given the discount rate too. Now, that discount rate is the cost of debt, all right? Is the cost of debt, okay? So what discount rate to be used? So this last statement, this is a very important statement. Keep this in mind, this is always the case. The discount rate you use depends on the riskiness of the cash flow. All right? So let's say you invest in government treasury bill. Now theoretically, it is risk-free. So when I say risk-free, it is default risk-free. There's no chance of bankruptcy. But government, they can always print the money and give it to you, right? But the purchasing power of that, let's say $1 million, may be nothing, right? If they have an extremely high inflation, even they pay you $1 million in 1 year, but $1 million you may not be able to even buy a bottle of drink, right? But it's still risk-free, means no default risk, okay? So if this is no default risk, you may require a lower return. But now you have, let's say, another investment. This is a startup, this is a technology startup. So they don't have a product, they just have an idea. So now they want you to invest. They want to borrow money from you, right? And you invest in this company. So what's the required return? Extremely, extremely, extremely large, right? Because the probability of failure is high. So you may lose everything. So you require higher return. Okay? So it always depends on the market risk of the cash flow. Depends on the riskiness of the cash flow. Alright? So another example I want you to remember me forever is using this example is I want to borrow money from you. Alright? Another person, Elon Musk, he also want to borrow money from you. Alright? So we both promise to pay you back $1 million in 1 year. So the question is how much you are willing to lend to Derek and Elon Musk. Alright? So some people were very nice to me saying, okay, I promise to give you back $1 million, you lend me 0.9 million today. So you require about a 10% return, right? But Elon Musk, you probably would not require 10% return. So maybe you want to lend 0.99 million to Elon Musk today. So you just require 1% because this is almost risk-free. 1 year later, no matter what happened, I believe Elon Musk's net worth will be more than $1 million. Right? 1 year later, my net worth, I don't know whether it will be more than 1 million. Maybe I make a bad investment decision, I lose everything. Alright? Alright? Elon Musk still have that possibility, but extremely, extremely, extremely small. Okay? So therefore you require high return from me because this promised cash flow has a higher risk than this promised cash flow. Okay? It always depends on the riskiness of the cash flow. Okay? Now, if you are not sure about the riskiness of the cash flow, then the second way to determine what discount rate to be used is to look at who is going to receive the cash flow. So in the early example, I said, well, in stock valuation, who is going to receive a dividend? Shareholder. Then we should use their required rate of return, the cost of equity. Because when they invest in the company's equity, they should have done the homework. They should have assessed the riskiness of this dividend. So they study everything, they do the due diligence, and then they require that return. So that required return reflects the riskiness of the dividend they expect to receive. All right? Now, in bond valuation, so if the payment, the interest, and the payment of principal, they are paid to the bondholder, right? So in that case, what discount rate we should use? We use the bondholder required rate of return. Again, when the bank lend money to a company, they assess the riskiness of this company cash flow. If they think they are very safe, they will require a lower rate return. If they think, oh, this is a risky company, they require higher return. All right? Now, in capital budgeting, this is the cash flow to the whole company. Right? The company have this project, so this is the cash flow to the company. So when we discount it, we use the weighted average cost of capital, including both shareholder and bondholder, because there's a whole company. All right? So keep this in mind. The first principle is always depends on riskiness of cash flow. Second is, if I'm not sure, then look at who is going to receive the cash flow. If bondholder, then use their cost of debt. If the shareholder receive the cash flow, use cost of equity. If this cash flow is from a whole firm, use the WACC, weighted average cost of capital. All right? Now the sources and the cost of capital. Now even though I put 3 different sources, but in this course, most of the question, we assume preferred stock is 0. Right? For simplicity, just make sure you understand the concept. And very often we assume preferred stock is 0. All right? But in reality, some company they issue preferred stock, but their weights are relatively small, maybe only a few % of the total capitalization of a company. right? Most of the company, their capitalization, maybe 95% or maybe 95, 98%, they are either debt or common stock. Only a few percent is or are preferred stock. Okay? Now, the second one is to calculate cost of capital. So when I say cost of capital, it means weighted average cost of capital. Now, we should use a market value if the market value information is available. We only use accounting book value as a second best solution if we don't know the market value. All right? So if you have the market value, you should calculate the WACC using the market value as a weight. All right? Now, if you look at it, why this is just RS, the cost of equity? Oh, I forget this one here. I want to make sure you have understand this concept too. Okay? What's the difference between expected return and required rate of return? Now, in this course, very often, even in textbook, we use these two terms interchangeably. But theoretically, these two terms has a little bit different definition. All right? Now, let's look at this example. Assume there's an investment that gives you $10 per year forever. Promise. They promise $10 per year forever. Now, you are one of the potential investor, so you study this company, you think, okay, for this level of risk, I require 10% return. So I require 10% return for this level of risk. So you discount it, that gives you $100. So this is your value. This is your estimated value of this company.